Hey guys, welcome to another video and thanks for joining this live session here. Just want to cover a few things today. I believe that when it comes to investing, one of the things that we ought to do is to understand the strategies that we employ or that we use in, reaching our set goals. And investing is definitely one way to reach your retirement goals, to save towards a down payment towards a house. It's one of the ways that you also can save for college education, for various reasons. And one thing that we all do is that we always want to see our money go up in value, increase our net worth, increase our income, things of that nature. And if we choose the right vehicles to help us reach those goals, then it makes it a lot easier. We get to achieve those goals without, losing or getting bruised in the way. Now, investing does involve risk, and that's something that I think I should tell you up front in this video. And of course, if you haven't subscribed to the channel, please don't forget to subscribe to the channel. It goes a long way. Your likes, your comments, and questions are definitely welcome. Then make sure my audio is pretty good here. Now, one thing I will say, make sure that's good. All right, cool. All right, one thing I want to say is that if you are new to investing, all right, one of the things that we always do is we always want to find, what should I invest in? Because, hey, you have real estate, you have stocks, you have bonds, you have cryptocurrencies, you have gold, you have commodities, and all of this can definitely make investing very difficult to execute on, or at least get going with your plans. The truth is, investing isn't complicated. Now, there are levels to it, because when you start getting to things like options, futures, forex trading, now there's definitely strategies that people use, and I'm not an expert in some of those, but having an understanding of various types of investments definitely would help you to simplify and choose the right type of investment for you. Some people don't like taking risks, and that means that they would prefer to put their money in a savings account. Some people do not like taking, putting their money into something that they believe today it's up, then tomorrow it's down. Think about cryptocurrencies, for example. Where, on the other hand, some people like that. You have to find what works for you. You have to find what suits your lifestyle, what suits your own emotional needs. Because if you do not consider those things, you may find yourself investing in something that isn't for you, and that is not what you want. Now, is it important? I think, and this is a question that I wish I could get an answer to, but don't you think it is important to be exposed to various types of investments? The reason why I ask this question is that, and whoever I'm talking to, I always ask this question: what is your goal? Why do you want to invest? What are you trying to achieve? And what's the time frame you have set for this goal that you want to achieve? Because that will determine the type of investment that can make that happen, right? That gives you the opportunity to achieve that. Nothing is guaranteed. We all know that the economic crashes, there was COVID in the last in 2020, there was economic crashes that has occurred in the past. There are times when the economy takes a dump, right? All those things will happen, but a particular type of investment can only, or at least a return on investment can only be achieved on certain type of investments. And let me make that clear. For example, if you put your money in a savings account, you can't expect to make 10% on your money. It's not possible. It just is impossible. Why? Because a savings account nowadays would only pay you anywhere from maybe 0.01% to anywhere maybe 3%. If you're lucky, you may see some 4% if you do like a CD, certificate of deposit, which I also cover on this channel. So if you want to invest in something that will give you 10%, then you shouldn't be looking at savings account. You shouldn't be looking at bonds. You shouldn't be looking at maybe gold. You shouldn't be looking at those. Why? Because gold, up until recently, was literally flat for almost a decade. So where am I going with this? When it comes to investing, you have to choose the right vehicle for you. Now, because a lot of people might be new to investing, you find yourself trying to, invest in a type. Sorry about that. I think I clicked mute. Let me fix this real quickly here. Properties. You find yourself investing in things that may not be suitable, to you, to your lifestyle. And that is something that ends up putting people in a lot of problems, or at least in trouble. So what do you do? What do you want to do? Well, in this video, I'm talking about the 3 types of ETFs, exchange traded funds, that you can put your money into. Exchange traded funds are literally traded like stocks. And when I say stocks, I'm talking about, trading shares of a company. So if you have an ETF, let's say example would be the Vanguard VOO or Vanguard VYM or the VTI. All these ETFs those are the ticker symbol, which I'm going to show some of them shortly here. These are examples of ETFs that you can buy on trade on a regular basis. This is VTI right there. Okay. Vanguard Total Stock Market ETF. The second one is VOO, which is the Vanguard S&P 500 ETF. Another one, which really covers the 3 that I'm talking about today. The third one is the Vanguard High Dividend Yield ETF. These 3 ETFs are generally very safe with consistent returns. Now, the reason why ETFs are better, well, in my opinion, in the sense that if you're new and you are not sure of what company to invest in, what ETFs to choose, and making just go with something like, well, this is not financial advice, like I always say, but it's something that gives you the ability to get exposure to different companies. So that means diversification is built into this. So think about a basket, right? In that basket, a fund manager, right, has chosen different companies into the basket. And by doing this, it simplifies the process for you. You don't have to worry about, what company should I invest in? You don't have to worry about what percentage of the company should I have, because that's another thing that people don't think about. You buy, you have your own portfolio, right, on an investment app, and people would choose, let me just I have $1,000, for example. I'm just going to buy $500 of Apple, and then I'm going to buy another $500 of Tesla, and then I'm going to hope it goes up to $10,000 in total. Well, it doesn't work like that. I'm sure you've probably seen that. And why? Because first of all, you've gone 50% and 50% on these 2 companies, which means that if one of them takes a dump, you're literally out of $500, for example, if it goes to 0. And that means your other one has to do 100%, okay, in order to even get back to where you started from. And this is called position sizing. And the whole idea is that if you're putting yourself, or you do not manage the percentages of the stocks that you're holding, you could find yourself, even though you have good stocks that have done really well, but because you've put in so much money in a particular stock, in a particular company, then if that goes down, it draws down the whole portfolio itself. So that is something that people don't think about. But with an ETF, like the one I just showed here, the VTI, Vanguard Total Stock Market ETF, you have a blend of stocks. Okay. One, it's an index style management style, which means that it tracks a group of companies. All right. When it's an index, so for example, you have the S&P 500 is an index. You have the Dow is an index. There's so many indexes all around the world, right? Indexes, whichever party you belong to, right? So the point here is it is not actively managed. That's a key thing that I want you to keep in mind. And why is that important? The reason why that is important is because if it's actively managed, well, they will charge a lot more fees, and that's why the expense ratio is only 0.03%. Okay. And of course, this is mostly US domestic stock in general. All right. So it's mostly US stocks that you'll find here. And you can see it here. Product summary 6 to track the performance of the CRSP US Total Stock Market Index. One great thing that you would see here is this is only year-to-date returns. So literally, if you had invested, let's say, $100 in this at the beginning of 2025, you would have made 6%, which would have been $6. And you can also do that, say, for $1,000, you'd have made $60. If it's $10,000, you made $600, right? So it all goes on like that. Now, the point here is, this ETF, which is the first one, right? Like I said, this is the VTI, okay? You have low fees, you have excellent performance over the years. Excellent performance over the years. All you see here, all right, VTI, 5% month-end return, 3-month total, 10%. Year-to-date is only 5%. And I know why that is. We know that we had the Liberation Day announcement. We tanked the stock market, okay? But we're back. We're back to where a little bit more than where we started from, okay? At the beginning of the year, if you look at the charts anyway. But 1 year, we're up 15%, 3 years, 19%, 5 years, 15%, 10 years, 12%, and since inception of 2021, up 8.9%, 8.95%, almost 9%. Now, the current price of this is 307. Now, this is important. Why? Because if you look at this, let me change something here. Make that like that. All right, cool. If we look at buying shares of a company, let's say it's Apple, right? Apple is around 212 last time I checked. If you were to buy it right now, okay, on the stock market, you would be paying $212. For this one, if you're going to buy it right now, you pay $307. And like I said, it trades, within when the stock market is open. So you can literally buy this and sell tomorrow if you want. Of course, that's not the goal. The goal is to buy and hold. We want to buy and hold this type of ETF and continue to invest on a regular basis over time. That is the goal here. Now, if you look at a hypothetical, sometimes they give an hypothetical investment chart, but this is not even here actually. Here, these are the price performance over the years. So let me go back to page 3 here. So this is the most current price as of yesterday, 305, and it's up $2 today. But as of 6/3, so about a month ago, it was 293. Okay, so it's steadily gone up. That's the goal here. But here's where I want us to pay attention to. All right, one of the things you see here is number of stocks. This has about 3,555 stocks. You find here, you have the benchmark, which is what it tracks. Okay, it has 3,517. So it actually has more stocks. Now, this can be a good thing and to also be a bad thing. Good thing in the sense that you have a lot of companies, so it's well diversified, but also it also impacts the performance because not all stocks will do well. So which means that some stocks will perform well and some will not do well. So it kind of average out over time. Now, one of the things that you'll see that is important to also keep in mind is the type of the market cap of the companies that you have in this. All right, so for example, you have mostly a blend of value and growth stocks, so that's why they call it a blend of them, and they are mostly large cap or large market capitalization companies. So in this case, they have, I believe is it 10 billion or 100 billion, one of them. Companies that are worth more than that value. And you can see median market cap, so of the companies that you have, is around $203 billion. And examples of companies you find here, okay, or at least the sectors, and of course you can go into the companies themselves, but let's talk about sectors here. You have basic materials, consumer discretionary, consumer staples, energy, financials, and it goes on. But here's what I want you to also pay attention to. Remember when we talked about the percentages of companies that you hold, or the sectors in this particular example, but it also could be companies that you hold in a portfolio. One of the things that you want to consider is what is the percentage of these sectors that you have. For example, this is mostly what? Technology. 34% is in technology. Okay. Then you have 2% in telecommunications. I think the next bigger value or biggest one would be 14%. That's consumer discretionary. Okay, so it's 14.9, followed by the 13 industrials. And it goes on like that. So which, this is definitely exposed to the fluctuations that you would see in tech companies in terms of their stock performance. So, in the past couple of years, we know that tech has done really well and they've grown in value. That generally affects how this is distributed. Why? Because as those companies grow, their weighted average increases within the portfolio. So for example, if you had let's assume that you invested $1,000 in 3 companies, or let's say $1,000 in 4 companies. So you had 250 in one. In, let's say, technology, you had 250 in real estate, you had 250 in, let's say, industrials, and 250 in healthcare. Tech has done really well in the past, say, 5 years. Now, let's say your $250 that you put in tech is now $500. Now, the portfolio weighted values is mostly in tech now, because let's say it's now $500 and industrials hasn't really done well. Real estate has kind of been flat. So they're still like 250, 260, 270, somewhere there. But your tech is the one really dominating the portfolio. So that's what you would see here. And that is normal for most of these ETFs. Why? Because tech has done really well. Even if you look at the S&P 500, right? Most of the tech, what do you call it? The Mark 7 are the ones that have really dominated the S&P 500 performance even in the past 3 years. So that means that if those companies take a hit, maybe due to tariffs, maybe due to some regulation, that generally draws down how the index perform. So that's something you need to keep in mind. And that's where we can then talk about rebalancing. Why is it important to rebalance your portfolio? Because if you are somebody who's, say you've invested in S&P 500, now you've, not S&P 500, in tech companies, and you are heavy in tech companies, you should consider selling some of those tech companies and buying some that hasn't really done well. So for the example I gave, I chose these 4 sectors: healthcare, industrial, real estate, technology. And for any reason, technology has done really well, right? And I'm heavy on tech. Well, what I can do is to sell some tech. So I can sell maybe 1%, maybe 2% that I have in tech to buy, let's say it's healthcare, or maybe buy real estate, depending on what you think it's best. But with these ETFs, you don't have to worry about that, all right? Because it is done by the fund manager. And that is why when you invest in something like this, you don't have to worry about it. You don't have to do all that work. That's why it's great for people who are new, okay? Of course, if you're finding value in this, don't forget to drop a like on it, please. Also, what are the companies you can find in this ETF, this VTI particularly? You can see Microsoft. All right, the percentage of fund, 6% is in Microsoft, and Microsoft has done really well this year. Okay, you have Nvidia, which is another great one that has done really well. Apple, not so great, but not bad. It's still a good company. By the way, there's a report on Apple today that their sales has increased in China in comparison to the previous years, which is a good thing. So their stock is up. But the point here is, all of this Mag 7, part of the Mag 7 anyway, Google is not here. Actually, Google is there. Right, that's here. And Amazon, they are all here, right? So all of these companies have done really well. All of these are all tech companies, all right? All of them, okay? These are all tech companies. And you can see 6%, 5%, 5%. So for the, like I said, 34% of them in tech. And these are all companies that have done really well, that when you hold them, you don't have to worry. You don't have to think about it. Your money is invested in some of this. And it takes away the headache of figuring out what am I invested in, when should I rebalance, how should I rebalance, and that how much should I put in one on over the other. Those are ETFs that I have, and the reason why I'm sharing that is, when you have such in your portfolio, you don't have to worry. You don't have to worry at all. It takes away the stress. The second one that I want to share with you is the S&P 500, the Vanguard S&P 500 ETF. This is another one that has done really well. Let me go to window here. Actually, I need to resize this one. Let me do it that way. All right. So this S&P 500 ETF, VOO, that's the ticker for this one, this ticker symbol. We got it's an index as well, domestic index style, which means it's not actively managed. So something to keep in mind. And the reason why we talk about actively managed versus index, or in this case, passively managed ETF, is because of the expense ratio again. So pretty low expense ratio. And this is important because one of the ways that a lot of actively managed ETFs make money is through the fees they charge. So you may see some ETFs that actually charge maybe 0.6%, You may see some that charge up to 1%, actually, 0.6%. I've seen those before. That's really high. Okay. For this one, you have, let me go to performance and fees here. Over the years, okay, 3 months, at least 10%, year to date, 6%. In 1 year, it's returned 15.13. Okay. Let me make that better. All right. In 3 years, 19.6. In 5 years, 16.6. In 10 years, it's 13.6. And of course, since inception, it's 14%. Remember the question I asked at the beginning of this video? The question was, why do you think, if you're choosing an investment and let's say assume that you want to have 10% return on investment and you're like, I don't want to take risk. Well, a savings account is not going to give you 10%, right? Now, what type of investment will give you at least that type of 10%? At least gives you the opportunity, right? It's not guaranteed, but it gives you the opportunity to make that kind of, 10% return, 15% return and above. Is of course ETF without really taking on excessive risk. Remember, you can choose to invest in single stock into individual stocks or individual companies, and you can make 1,000% return. You can make 2,000% return, right? Depending on when you buy them. But the risk you're taking is also very high. And in order for you to make that kind of money and make sense of the amount of money you take out of it, that means you must be putting a lot of money into it. So the question you want to ask yourself is it worth putting a lot of money into a high risk play or investment? Now, if it's money that you're willing to lose, you got to remember that, because stocks can go to zero. It is possible. It can go to zero. Ask me how I know, right? Because I've done it before. PNTV, that's the name of the stock. I cannot forget. This company was, this was all during when they started legalizing, what was it called again? I can't remember the drugs now anyway, the company promised that the drug would do X, Y, and Z and all this stuff. I think it was a pharmaceutical company. But at the end of the day, the company went bankrupt. Why? Because they were doing all these experiments and all this stuff. I guess it didn't pan out, right? But if I had put a lot of money into it, guess what? I would have lost all that money. And for this stock one, the ETF, going back to this, all right, I kind of got digressed there. Going back to this ETF, the VOO 574, that's the current price. Okay. If we go to, let's go to the chart here. Similar blend in terms of investment style and market capitalization as well. Similar to the VTI that I shared earlier, large versus blend. This holds only 506 companies though, unlike the other one that held about 3,300 and something stocks. This only has 506 in it. Expense ratio is pretty cheap, a little bit different in terms of diversifications and how it's weighted, slightly different from the VTI, but you can see information technology is still about 31%. The other one was about 34%. The next bigger one here is financials, and you can see this has 14%, which is great. Banks have done really well as well this period. The Chase, the Bank of America, the Wells Fargo, and the likes. They've done really well, and investing in them wouldn't have been a wrong thing. Now, one of the things that you would see with this is that you don't. This pays dividends. It's quarterly, but let me actually do something I wanted to share on this one. You don't see a lot of can't even find it now. Let's take a look. The VTI, which is here, has only returned about 8.95% since inception in 2001, whereas this one has returned 14.5% since 2010. So definitely this has VTI as been in existence since its inception, has been around for a much longer period compared to the VOO. But the key thing here is this is another great ETF to hold that gives you a lot of exposure to great companies, takes out the stress, but is more concentrated. All right, more concentrated in the sense that you have it in fewer stocks. right? VTI has 3,000 companies. This VOO has about 500 companies. So it's more concentrated, but with better performance. And why? Because those few companies, oh yeah, the companies, that's what I was looking for. Which I'm not, I didn't see it here, but I think I can find it under, it's kind of interesting. The other one had it, this doesn't have it. Yeah, to see like the distribution of the companies itself in each, how they are invested in companies, right? Like the VTI that I showed here, right here. Like the VTI has, now I have to go to like the brochure to find that information. Like this has, you know, the Microsoft, Nvidia, and the likes. I wanted to see that for the VOO, but it's not showing up right here. Now I know that if I pull up the brochure for the prospectus itself, I can find that information, but I feel like that's going to take more time to find. The last one, the last ETF that should be considered is VOIM. And why is VOIM important? All right, so we've talked about VTI, VOO. Those two are very important, in my opinion, in any investment portfolio, especially if you're self-managing anyway. Why? Because one, VTI gives you exposure to over 3,000 companies. Okay, VOO gives you exposure to 500 companies, but more concentrated to specific in terms of the, you know, because you have less companies, which means that your money is invested, more of it in individual companies that are held within the ETF. I hope that makes sense. I hope I'm saying it correctly, but I hope that makes sense, right? So where I'm going with that is because of the concentration, which it tracks, by the way, the VOO tracks the S&P 500. Because of that concentration in those 500 companies, it means that, well, you would generally get the returns that you get on the S&P 500. Okay, so it's just, again, it tracks the index. Why is the Vanguard High Dividend Yield ETF important in this? All right, we talk about dividends as well. Dividends is one of the ways that you can make money, okay, passively. And think about it this way: even though VOO pays some dividends, VTI may pay some dividends, VOIM is mostly geared towards companies that pay dividends consistently, and they can even be dividend aristocrats or dividend kings. These are companies that have been paying dividends for, you know, maybe it's 50 years, or maybe it's paying dividends for over 25 years, and they've steadily increased them, right? These are companies that are known for paying dividends, all right? And this is good, especially for retired people, right, where you can make money, at least get paid cash towards your daily expenses and the likes, okay? And that's where dividends can come in handy. And that's why I would definitely, you know, I hold this as well, but that's definitely why I would recommend it, because in times when the market goes down in value due to whatever, right? Let's say there's terrible news, there's something going on in the stock market takes a dip, the values of stocks go down, dividends will still pay most of the time, right? Remember, dividends are not guaranteed. Dividends can change, they can cut dividends, all this stuff can happen. But again, when you're not heavily invested in one company and you're diversified amongst the various companies, it makes it easier, all right, to somewhat rely on getting paid a dividend at the end of, say, a quarter. All right, there are monthly paying dividends as well, but for this, I believe it's paid every quarter. Expense ratio on this one is 0.6%. It's index style as well. So again, it's not actively managed. So 0.6, again, not too bad. A little bit more expensive than the other ones that we've seen that were 0.03. But this is great. All right, 0.06 isn't bad. All right, year-to-date returns, all right. Year-to-date returns 7.22, and year-to-date returns 7.26, slight difference there. We have 6 to track the performance of FTSE High Dividend Yield Index, which measures the investment return of common stocks of companies characterized by high dividend yields. All right, that's the key thing here. Current price for this one is around $135 per share. Okay, and let's look at the returns over 4 months, 3 months, year to date, of course, and we have 15%. If I go to the window here, let me switch this around so you can see that. And then we have 3 years, 12.8, 5 years, 14, and of course, since inception is 8.7. So not bad. This is definitely beating inflation. This is definitely close to that 10% mark that we want to be, especially if you look at these numbers in the past couple of years. They are all above 10%, right? And since inception, it's been 8.7, so not bad at all. Um, the other important thing that I would share here is how this is slightly different. What we look for is what? We're not looking for growth in the style of in the companies that we invest in. We're not looking for growth stocks. We're not looking for, we're looking for value stocks. On the market caps, on the market cap side, we're looking for large companies. Why? These are reputable, reliable companies that will steadily pay dividends, hopefully on a regular basis. Yeah, one or two may cut dividends, some will increase dividends. The goal is that at the end of it all, the average comes out to be, you know, great for people who hold this and can rely on that money. Why is this important? It is important to have a mix of, you know, of this in your portfolio, because when the stocks go down, dividends still come in, you still get paid. That is great. And that is money you can withdraw to pay bills, right? That is something you can withdraw for feeding. That is something you can withdraw to, I don't know, depending on the, of course, remember, it all depends on the size of the portfolio. If you hold, you know, 50,000 worth of this, right, or 10,000 worth of this, you definitely see something tangible. I mean, it's not going to be a lot of money, okay? And by the way, there's always a calculator that you can use online, freely available, to calculate how much you earn if you've invested, let's say 10,000 or 20,000 or 50,000 or 100,000, okay, and above. And it to show to you, and literally you can put in the VYM ticker symbol, and it to tell you how much you earn based on the amount of money that you invested, okay? But the reason why this is important, again, is that income that you can rely on for most part. Remember, nothing is guaranteed. They can cut dividends. They can stop dividend payments. Why? Because the company didn't make profit, right? If they don't make profit, there's no dividends to pay out, right? What we have here, you can see this is slightly dialed back in terms of the, let me switch this over. All right, as you can see for the tech, what we've seen in the past two companies. Sorry about that. I felt like I just had to sneeze. What we've seen in the past two companies, we saw that technology was quite heavy, or was what the other VOO, VTI, they were quite heavy on tech. And one of them was heavy on financials. The other one was heavy on consumer discretionary. Okay, for VYM, we have tech at 11%, but we are much heavier, or the heaviest sector here would be the financials, which is at 21%. And then, of course, followed by industrials and the likes. Now, of course, if you think about companies like Procter & Gamble, Coca-Cola, all that, right? They've all fallen under the consumer discretionary side. Some of them will fall under consumer staple sides. Some of them will fall under the industrial as well. And dividends, right, per share, this was 624, 086. So you can see how the dividend value changes per share. Okay, so this was 0.65 as of March 24. Okay, and then as of June 24 was $1, and then it, so the point is that the dividend value would always change. Sometimes it's not the same. Let's assume you're getting paid $100. It's not going to be $100 every month. That's what I mean. That's what that means, right? It's always depend on various factors. All right. So those are the three ETFs. All right. Those are the three ETFs. Now, if you have a Vanguard account, of course, makes it easy. You can easily just click buy. You have money in there already. You can buy, purchase, and then you're good. On the other hand, if you're looking for a brokerage account, you can always use things like Robinhood, which is one of the ones that I believe is very user friendly, and it's doing really well lately. That's another investment brokerage investment app that you can use. You have, Schwab, there's so many of them. Vanguard, Schwab, you have, what's the other one that I was thinking about? Moomoo account, M1 Finance, SoFi, so many of them, right? Choose what you feel comfortable using and get started. This would help. Now, there's one ETF that hasn't been mentioned here. As you can see, the risk, okay, and I'm going to share this here if you're still here, of course. The risk with investing in this particular ETF, so VOO, VTI, and VYM, the risk is that you're mostly investing in US companies, all right? US companies. And it's always good to get exposure to other companies as well, companies outside of the US. And that's where an international fund becomes important, okay? So that you can get some exposure. The truth is that most of those haven't really done well lately. But let me show you one, for example, which this is a bonus one. But the reason why I personally, I'm not a fan of, it's good to get exposure. All right. It's good to get exposure to international. This is a Vanguard VX US, Vanguard Total International Stock ETF. All right. These are all international / global stocks. All right. More risk. Slightly not too high expense ratio, but you get exposure to foreign companies, all right, which can be very beneficial because guess what? There are other companies, other parts of the world that are doing well. So, for example, this gets exposure into emerging markets, Europe, Pacific. You have Middle East, North America, and of course other. Europe is where most of it is. Most companies that you'll be investing in are, so 40% there, followed by 26% in emerging markets, and Pacific 25%. Let me see actually if they have the current price on this one. Let me look at the price here. 69.33. All right. This gives you exposure to foreign companies, and that's something that is important. Not sometimes being heavily dominated, having a stock that is mostly US also becomes a risk, right? Because now you're heavy on just the US stocks, which means if something goes wrong with the US, all right, or the dollar, the struggle between the dollar and the euro and just the currencies in this case, right? How dollar is still dominating the world. But remember, every country is trying to find for dominance. And if that changes at some point, that could also affect the performance of these companies that you invest in, which means, if your VYM, your VOO, and the likes can take a dip, right? And these foreign stocks can perform. As you can see, the performance of this one hasn't been stellar, and that's why I didn't mention it, right? But it's good to get exposure, even if it's just a little bit, right, of money is invested here. Like you can see, this one has the month end is 3.8, 3 months total 12%, year to date 18%. So this has been not bad at all. This has been good. So you got 10, but you can see since inception it's only 5.3%. 10 years only 6.3%. But maybe paying attention now is important. Why? Because in the recent times anyway, you've seen we've really done well on the international side. Yeah. All right. Well, that's really all I wanted to cover in this video. If you found value in this one, please do not forget to drop a like on the video. Don't forget to subscribe to the channel. It goes a long way. And I'll see you in a future video. Please let me know, if you have any suggestions, if you have any ideas. It would definitely help to get them and work on what we talk about here, and hopefully we can continue to learn and improve together. Take care.